All right. Welcome, everybody, to the Value Seville podcast. I'm your host, Jeff Hendrickson, and this is part two of our interview with Jeremy Deal. In part two, we delve into topics such as volatility and position sizing, all within the context of managing a portfolio of guerrilla positions. And we talk about the ways that the power law distribution not only determines or best describes economic and investing outcomes, but it also does a pretty good job of describing the ways that the decisions we make affect the trajectory of our lives. So please sit back, relax, and enjoy part two of our interview with Jeremy Deal.
Taking a first principles approach, if you were someone today who was going to build a portfolio, how would you go about putting together one using this kind of framework? Is it you would weight heavily into guerrillas you knew were guerrillas today, emerging guerrillas? I think Paul talked a lot about near leaders, emerging leaders, clear leaders.
Yes.
But maybe just go through that a little bit, because I think it's helpful to think about the time, because there's a mental allocation to each of these kind of these buckets, but it would be helpful to kind of hear your thoughts on that.
Yeah, it's there's no really right answer. It's like anything. There's a lot of structural shifts happening all the time in society, and I would pick, a handful of them that you're passionate about or you could get really interested in. There's a lot of structural shifts that are niche-y and small, but you may not be that interested in. And some of the big ones, you may not be interested in. I mean, I was with an investor this weekend. Our kids were playing together, and we were chatting about one of the emerging mega trends of stable coins. And I realized after, and the Genius Bill or Genius Act that just passed in the US, which gave a regulatory framework around a US stable coin. And, I'm familiar with it. I followed it, but I realized after that conversation that he just knows so much more about it. And I just don't know much about it. It's not, and I agree that it is probably a megatrend. The digitalization of the dollar and currency is a structural shift that, you're not putting that toothpaste back in the tube. But the question is do you have an interest to go and hunt and spend the time and try to find something that you can own? And there may not be anything that you can own today. And it may be that you just kind of lock that away and know that's a shift and it's a megatrend, but you sort of think about who would be a beneficiary of that. Do you want to own the beneficiary of that, or do you want to own the company maybe that's a key player in that? Or do you not want to own anything in it at all? So I would look for a handful of megatrends that you're interested in, and then kind of look for ways you could invest either directly or indirectly. And I think sometimes the indirect investments, the second order effects, are actually where all the money is made. And you can see that, Apple, they didn't, they were sort of a beneficiary of the internet. They were a beneficiary of a lot of things, of international trade, globalization. They benefited from all these things, and it sort of came together. Versus, as we know, history, things like broadband. The early investors in broadband seemingly lost their shirts because they overpaid, and they were right about investing in the cables went in the ground, but it was actually other companies that benefited a lot more from broadband than the broadband people that actually built it. So you have to just kind of think through and build friendships and connections of people that are experts in those fields, and just go out and talk, and I think understand the megatrend. And then from there, you sort of have to flip the switch and sort of become a value investor and be able to imagine, set up, first of all, identify what you think are great companies, and then look at those companies and try to imagine what could they be, 10 or 20 or 50 times bigger if things go well. And what is the margin of safety here? If it's not just pure valuation, I mean, valuation's really not a margin of safety. I mean, a lot of the things I've seen go down the most start out looking cheap, but they just get cheaper. So, maybe you look at the margin of safety in a non-traditional sense, like what is their advantage culturally and technologically, and what are they doing that others can't, and there's just a lot of ways to think through. It's a big Rubik's cube you're trying to solve, and so I would focus on a handful of things and drill down, and then put your investigative hat on and try to find stuff that you think is going to be a beneficiary, and then figure out a way to monitor it in a way that you could be honest with yourself that when the tie, if things change or don't work out, you can sell the business, you can sell the stock. So I guess Jeremy, it's a very long-winded explanation.
Yeah.
So my pushback,
Good. It was good. It was great, actually.
My pushback on this idea would be, I guess it implies a relatively high degree of concentration. You know, I don't know if this is 5, 10 stocks, 15, maybe call it something like that. In a concentrated portfolio, and look, I think there are benefits to being concentrated. But one of the downsides to it is that if you have 20%, say, of your AUM in a name, and selling that name means having to put 20% of your money to work in some other area that you don't know as much about, that you don't have the level of conviction. I feel, my hypothesis at least, is that this could bias people to look the other way when they get to disconfirming evidence, because you want your 20% position to work, right? You don't want to have to take 20% of your portfolio, go to cash, and then go find a new use for it. So how do you manage the potential for bias on a large position? And is this something that worries you, or is it something that you think you just need to be mature enough to know, hey, if I have to have 20% in cash tomorrow because the thesis has changed, then so be it. Walk me through how you think about that.
Wait, hold on. Can I add one point? Because I think there's also the other side of this too, which is, how do you know when you're 20% invested and the thesis is going well when you should go to 40% invested, right? Like,
this is true.
So there's two sides of the coin, right?
Yeah, because the flip side, and we talked about this.
Yeah.
Before, was that, like, take Amazon. I mean, if Amazon is let's say you have a 2-stock portfolio, right? Google and Amazon, right? And they're both, actually, take a better example. Let's say you have a 2-stock portfolio, Amazon and some other company. And let's go back to 2003, 4, in that area. How many people just continue to hold Amazon at the current, weight and just let that weight ride? Well, almost nobody, because, if you get to, I don't know, even 5 years ago, Amazon would have been such a large percent of your net worth at that point, that how many people really would just say, I'm never selling? It's prudent investing would be like, I need to shave some of this shit off because I can't, I'm a multimillionaire now, but now all of my money is wrapped up in this one name. And if that doesn't go well, so there's that element too on how you size it, whether it needs to go up or down. Anyway, there's a lot to think about there, but walk us through it, Jeremy. How do you think about these issues?
If you look at the Forbes list, there isn't anybody on there that made the money themselves generally that didn't do it in a concentrated way. I mean, most of the people on the Forbes list, and potentially all of them, the vast majority of their money was made in one business, or inheriting the stock of one business. And there's something about this where when it's, 50% or 40% of a fund with outside capital, that it feels really, I don't know, you feel this sensitivity towards the volatility much more so than if it's a business that's maybe been in your family, or that you started and it's 99% of your net worth. Somehow, I guess that's easier to own. I was just listening to an interview with the In-N-Out Burger heir, the girl whose father and uncle died in a plane crash, and thus she inherited all the stock of the company. And I was thinking about that. On paper it's whatever, many billions, 7, 8, 9, 10 billion valuation, who knows. But is she worried about that? Is she worried about the fact that she's 8 billion? Is she rushing out there to go sell to a private equity fund so she can diversify?
Burger's that
No,
good? No.
she's very, very comfortable, seemingly, from what I can tell, owning that business, and wants to pass that on, and that's, it's great. So I do think it's easier if there's a point at which it actually becomes easier. I think when you have a high quality business, when you know that business really, really, really well, it's actually higher risk to sell it and own things that you don't really know that well, just because you're afraid of volatility, you're afraid of it going down. So it's more of a question of how well do you think you know the business. Obviously anything can go wrong. I mean, the people that that Waltons famously were the only, at least, shareholder of record from IPO date to today. And you'd probably find something similar with Amazon. It's Jeff Bezos, his brother, and a handful of other people in the Bezos family are probably, and maybe there's a handful of others, but there's not that many people that we're able to hold. But those people are extraordinarily wealthy, and this is why there's just one of the reasons why there's just not a lot of people with tons and tons of money. I mean, it's people can, they can only take so much. They can, there's a point where if they don't understand the business well enough, or things change, or they can't handle the idea of it going down on paper, they can't do it. Most people, though, they have all their net worth, or a lot of their net worth, in a home, which is levered. And if it was publicly traded, if every time somebody had to walk by that house, they had to put a bid in to get to the other side, get to the other side of the street, and you had hundreds of people potentially, or dozens of people a day putting in a random bid knowing nothing about that house, like what do you think it's worth in order to cross the street, you would see all kinds of crazy fluctuations. And if you took into consideration the leverage that most people have on their home, they could potentially
Right.
get wiped out on a daily basis. And so that's sort of what's happening in the stock market. I think it's
This is a good
becomes
analogy. I like it.
it comes down to how well do you know the business. And obviously the bigger the position becomes, the better you need to know it, but at the same time you can't know everything. I think Munger was asked about this question about Costco. Now, nobody ever asked him about his concentration in Berkshire Hathaway. Nobody ever said, why didn't you diversify out, or do you feel uncomfortable having whatever he says, whatever it was, 80% of his net worth in Berkshire. But they pick on him with Costco because it was so seemingly expensive and it had been such a multi-bagger for him. And I think his response, or maybe it was Manish Pabrad who was telling the story of Munger telling him the story or something like this. But the genesis, from what I can remember, was that there's no, at some point you just have to if it's a great business and it has a long runway ahead of it, and it's out competing everybody, and that moat just continues to widen, you just have to let the valuation go. You just have to let it be. And maybe it's going to be 20% overvalued or 30% overvalued at some time. And it's another time it's going to be 20% undervalued or 30% undervalued. But maybe at that point, your job isn't necessarily just to constantly just fire sell the stock because it's 20 or 30% overvalued, and then just pile drive back into the stock because it's 20%, 20 or 30% below. And there are some funds and third-party managers that invest like that, and that's totally fine. But I think as a real owner, if you're looking at a stock like you own the business, which is what Buffett taught us and Graham taught him, then it's really hard to sell. Once you find a gorilla, we know how rare they are, and a gorilla that you can actually you identified and that you can build the conviction and you can hold, and it has that long-term horizon in front of it. It's difficult, I think, and actually more risky or riskier to just fire sell it just because of valuation, unless the valuation just becomes so extreme. And you could argue there's companies like that in the stock market. Say there always are stocks like that in the market that are just extraordinarily potentially overvalued, but you don't know. You don't really know because you don't really know those businesses. I mean, I could name them because everybody talks about them now, but I think that I don't want to do that because I don't actually know those businesses that people talk about as being so overvalued. I don't have a real insight into those businesses. And when I look at the people that control them or have big positions in them, they're famous investors, especially in tech, I can't come in as an armchair and as a guy watching the game on the couch on a Sunday, and screaming at the TV saying, you should have caught that ball. I don't know, so
Yeah.
who am I to judge? So I think it's being in your circle of competence and building that conviction. And actually, I think it was Rob Vernal said there's actually benefit to marrying your positions. So people always talk about you don't want to marry your positions, but he talks about there's actually opportunity in marrying your convictions. And yeah, you're gonna be down when maybe others aren't. You're not going to trim when you probably should have, but the upside for holding the right companies over the long term should far exceed the benefit you get from trimming a stock because it becomes goes from 20 to 25%, and you told everybody you didn't want to have something more than a 20% position, or it becomes 10 or 20 or 30% overvalued according to you. So all this it's a work in progress, which is what makes this game so fun.
Yeah, Jeremy, I
Right.
guess like one thing, if you're take the base case assumption of this strategy, and that's the way I think most of the people who would probably listen to this, they think about investing as well. You do know and fully expect to have like volatility, and way more than maybe someone who's in a fully diversified portfolio. And so I think there's like two questions there, right? Is one, you have investors with you, whether you run a fund or not, right? Even if you're running just your family's money, there are family constituents who have an interest in that as well, right? Even if it's just your 401k with your wife, right? So I guess it's just, how do you, and this kind of gets into maybe like kind of the personal side of this a little bit, is one is how do you think about that, preparing people that are your constituents for it? And then how do you personally, knowing that there are days when you're going to be way down compared to everybody else, and there might be even long periods, but over time, because look, I mean, if you go to like these companies, and I looked at a bunch of drawdowns from major companies, like Nvidia would be something that almost no one could have stomached that ride in some sense, right? But if you
No.
did, you made such incredible gains. But there's a reason why I think a lot of these endowments, like, they don't have any of their funds that have NVIDIA into it, right? And so I think if you're to think about just how do you personally prepare yourself and how do you prepare others for that, just to make sure you have the armor going into it.
I think that when you're running outside capital, you do have to be sensitive to what percentage of, your client's net worth is in the fund. It helps to obviously have a diversified client base and to know that your LPs don't have, 90% of their net worth in your fund. I mean, we're not financial advisors. So, in my case, I don't have a preview of, my investors. They're all qualified and accredited investors. I don't necessarily know what percentage of their net worth is in the fund, and some of them have a lot, over the time it's compounded and it's probably become a lot larger than it was initially. But I don't know, maybe they've made money doing other things. But ideally, it's a smaller percentage of their net worth, which allows you to sleep at night with the drawdowns because, that, you just, at least, you're not necessarily responsible for them not getting sleep because you're down a lot. The
Yeah,
other thing
sure.
too is I think it's about good communication. I think if you can communicate that the thesis is on track and that the business is actually benefiting from this really volatile period. I remember in 2022 we had the big sell-off. It made a lot of people question, like, well, were a lot of these companies just beneficiaries of a low interest rate environment? And that was the narrative for almost anything that had gone up a lot. And of course, sure, there were a lot of businesses that were just beneficiaries of a low interest rate environment and never recovered. But there were also a lot of businesses that suffered enormous drawdowns that are now have been multi-baggers, even if you had bought them at the peak of the 2020 or 2022 or 2021, let's call it, peak, and just top ticked it and then held it, and then you still would have made a multi-bagger return that would beat the market. And those are what we call survivors and thrivers. Companies that don't just survive but thrive, and they're companies that get stronger during those periods of time. Companies that can go after their competitors, that are in a position to say, okay, now we're going to shake loose all these little ankle biting competitors funded by venture capital that don't necessarily have to make money or don't have the scale to compete. And yeah, our stock goes down a lot, but can you clearly see that the business is actually getting stronger in this period and is going to emerge as a much, much better business, regardless of what happens to the stock price in the short term? And I think if you can answer those questions and communicate them and really see that, then you want to hold those businesses and communicate that and get excited about it and actually ask people maybe to put in even more capital because things are down a lot. On the other hand, if you have a business that you look up and say, you know what, we probably shouldn't have owned that. Yeah, we probably got a little ahead of ourselves. Yeah, I don't know if they're going to be able to recover. Yeah, if we go into a recession or this or that, the company's really not in a position to benefit from that because they're really not the market leader that we thought or don't have the competitive advantage that we thought. You need to sell them and take your licks and move on. So I think it's about learning how to communicate and communicating in an honest way to investors about what's going on, especially with the larger positions. So that's kind of the way I do it, or at least I try to do it.
Yeah.
I'm still learning, and a lot of times I don't necessarily know. I don't instantly know. But looking back at 2022, which was a rough year, I think for a lot of people, but us especially. Um, the companies that actually turned out to be multi-baggers measured from the top of 2021 really were the gorillas. They were what Utpal would say, I guess, were gorillas. They were market leaders. And not only were they market leaders, they really took advantage of the market sell-off and they were able to emerge much stronger. Kind of like maybe how Salesforce did after the dot-com bust, and some of those booking.com, some of those famous stories of Amazon, some of those multi-baggers that happened after the dot-com crash. So it's a long-winded way of saying, that's how I think about it. And I'm always trying to battle test and think through the thesis. Like if everything were to change tomorrow, if our biggest position were to be down, 20 or 30% or 50%, because of real fears in the sector or in the economy, would the business be in a position to get stronger? And because we're still benefiting from that structural change, has a structural shift, has anything happened to that? Are we still benefiting from a megatrend? And I would just keep kind of going back to those same questions. And if that breaks, then you have to sell it. But if it doesn't break, then you got to just hold, because you cannot let the price drive the narrative. That's the biggest problem
Yeah.
with public company investing is if the stock's down, everybody hates it. If the stock's up, everybody loves it. It's like everybody can understand a narrative as long as the price is supporting that narrative. So if the narrative is super negative and the stock is going down, everybody's like, yeah, yeah, yeah. But if it's the reverse and the narrative is very positive, but the stock price is going down, it's very difficult. People may understand that narrative, but they can't get behind it until the stock price goes up. And this is very different from private company investing where there is no efficiency, there's no mark to market. You don't know what the efficient price would be that day or that month or that year. It's just kind of like, well, it's held at cost. So as the private equity manager or the venture manager, you can just highlight all the greatness and the great things that are happening to that business, and you don't need to explain away the changes in the business as it relates to the price of the business, unless it's
Yeah.
distressed or something. So I think that what makes our business hard, yeah, we have access to these great, wonderful compounders and gorillas and the best businesses in the world and the best leaders, the best business leaders in the world and the best tech in the world and all that, but you have to deal with prices that don't always reflect the intrinsic value or what I'll call is the terminal value of these businesses. So yeah,
I
Yeah.
think it would
it's a
be
hard
I
game.
think it would be in everybody's interest, and I can't believe I'm going to say this on our podcast, but just take all the valuation books off your shelf and just forget about them to a large degree when it comes to investing in these companies. Because if you do a traditional DCF on a gorilla, more likely than not, you'll never own it because it will look too expensive at times. But I can tell you from my experience, I've, more, or not lost, but I guess you could say not accumulated more wealth by focusing on valuation than I have lost it by overpaying. And it's funny, when I first got into this business, I was told the exact opposite would happen. It was like, where you make your mistakes is when you overpay. Never overpay for growth, blah, 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 blah. That's what I was told. I never, by the way, look at shiny objects because that's where you lose money. So never invest in things like Bitcoin, man. They got that one wrong. So I think there's just a lot of traditional value investing tenets that worked really well, maybe over the last 40 years. But the idea that they work well in the current environment where you've got massive structural changes happening. We even talked about AI and some of the impacts it's going to have. When you have these non-mean reverting types of trends, the mega trends happening, applying traditional value metrics and thinking that that's a good idea, I don't know. I don't think it is. I think, to your point, Jeremy, you need to focus more on the quality of the business, the trend, whether or not it's in place, whether or not the company is still benefiting from it, and less on what its current PE is or EV to EBITDA, or pick your multiple, even EV to revenue, right? But look, we're an hour in here.
It's a game of unlearning and relearning,
Yes.
right? And that's
I think
that's
that's
what
it.
has been the most shocking thing about being in this game is how much you had learned early on and that you had to relearn.
Yeah.
Through your own hard knocks, right? Really.
And I'm still doing it. I mean,
Yeah, we all are.
oh,
It's powerful. It's powerful to learn and to evolve and grow. And to be fair, when I started, you really could. I started after the financial crisis, so you really could buy, quote unquote cheap stocks, and there was a period of mean reversion in the entire market. And but I think that the market's smarter than that. When you're in an economy that doesn't really grow that much and things are
yeah.
generally fully valued, you have to kind of think bigger and you have to, look beyond, all the small companies trading at 5 times earnings that, have been in business, been publicly traded for 20 plus years, and there's a reason they're still small.
Right.
Just ask yourself, like you said, through first principles, okay, why is that chemical company in Belgium, it's still trading for 5 times earnings and still only 100 million euro market cap, 30 years after going public. And
Yeah.
yeah, sure. If you took it private and, levered it up and sliced and diced it and financially engineered your way to an IRR, a time-weighted IRR for your LPs, which is what, private equity funds do. You could brag that, hey, I took this thing and rebuilt it and it turned lemons into lemonade. But if you're just going to be a passive investor, it has to, the business has to be able to grow and flourish and do well over a period of time if that's your strategy. So it just
Yeah.
leads you to thinking in a very different way because a
Well, you get a
business is more
natural
than its Yeah, sorry.
Oh, no, I was going to say you get a natural catalyst with the guerrilla, which is the growth, right? The growth is the catalyst. You don't need management to come in and slice and dice and spin this off and lever here, buy
Yeah.
back stock here, all these things. What's the
Yeah.
joke? If you want to get fired from your first day at a hedge fund, go in and pitch a sum of the parts valuation. You got this thing, and if we took this and sold it off and did all this, you get a 30% uplift. It's like, okay, dude, you're wasting my time here.
Yeah.
Well, look, we're an hour in, and as the host, I do have to kind of
Okay.
rein us in. We were trying to do 20-minute podcasts. Maybe that's not going to be as easy as we thought, Donnie. But this was such a good conversation. I'm glad we went. Okay, to wrap it up, Donnie, you had a couple. Did you have any questions, like general?
I just wanted to
wanted
throw this out. Okay, these are the 1% IRR. That's my kind of thing of just trying to get daily improvements or just small improvements, and that if you get enough of them, they compound into being major improvements. So, all right. So the one I want to, I'm going to just pick one of these that I kind of had. But you think in Pareto distribution, like it's your default case. That's kind of what we're talking about with these stocks. Distribution meaning 20% usually accounts for 80% of the value accretion, right? And in stocks, that's really pronounced. You can see where 20% of the stocks over history are the ones that really are positive in market value or above the market. And even if you take a second order Pareto distribution, it's really the top 4% are the ones that really drive all the market value. You can look at all that data.
Right.
Put aside stocks. Let's just take that's how I think you think. If I'm to, really play back your way of thinking investing is you're trying to find those kind of uber returns. Let's talk about that though to life. Pareto distribution for a life that you think about that maybe was this one small moment in your life that's had a major impact on you that maybe it's not an investing thing, it could be anything, but just trying to think about these big distributions that have had an effect on you.
Yeah, that's a great question. Yeah, and they say that when you're looking back, there's only a handful of decisions that you make in your life that really determine the outcome of your life, and it's very similar to investing. The person you decide to marry or be with, where you decide to, how you decide to live your life, if you're healthy or unhealthy, there's just a few decisions, but I would say definitely meeting my now wife and having the courage to move forward and to build a family with her, has been one of the greatest decisions I've ever made. It's had probably the most impactful. It's had the most impact on my life, and I look back as one of my kind of greatest achievements was marrying her and then having a family. So it. Yeah, it's kind of a little bit like investing. You have the tea leaves, we knew each other well and all that, but you don't really know how the future is going to go, and you have to take a leap of faith and you have to underwrite what you have in front of you. And
that's romantic.
But in my
I
case,
like it.
but in my, I mean, it's an investor podcast, so I guess you guys, people, and I'm sure she probably would say the same thing about me, but but yeah, that decision was definitely the best decision of my life, and Buffett talks about the two or three best investments he ever made, or the two best investments he ever made was a wedding ring and his home. So that really resonates with me as well. So
I always say that my wife's my best value investment. So it's been 10 years we've been married, so it's compounded pretty well over that time. But yeah, I mean, so any other moments that are maybe lighter, not quite as big, but that had an effect, even when you met Jeff, or going to Value X Clossers, any other kind of any other things?
Yeah, value.
I can tell that story.
Tell us, Jeff. You take over.
I'll say this: my best investment ever, full stop, was marrying Christina, my wife's. If we're going lighter and investing, one of the big decisions was when we went to Prague. It was right before COVID, 2020. So a little background of the audience. We were at Value X Closter, Spears event, and it was the last day. One of our other friends, I think the whole thing started, one of our other good buddies, I won't mention the name to protect the innocent, but came up to me and goes, how would you be interested in hearing a pitch on investing in an unprofitable pharma company that's being sued by the FTC? And I was like, well, that sounds like a great idea. Let's talk. And so we were one of the bars in Gloucester, I think, after the opera ski or however they say it, and talking about this idea, which at the time was in Videor, which was a very sketchy situation that ended up being a very good investment. But we're sitting there, and Jeremy's like, well, what do you do in the next couple of days? I was like, flying back home to Virginia. And he's like, well, why don't you get your ticket changed and come to Prague with us? We're going to go and just hang out for a few days. We can talk investments and have some Eastern European beers and see the city and just chill out. And I'm at the bar. I call Christina and I'm like, hey, do you care, if if I'm home, maybe a couple days later, and she's like, well, what's going on? I'm like, oh, I'm going to go to Prague with a couple of these guys, talk some investments. She's like, yeah, have fun, go nuts. And so I'm like, okay, this is cool. So then the next thing, I'm on my phone and I'm calling Amex, changing my flights. Somebody's ordering like a shot, and it's this big thing. And all of a sudden I'm like, all right, the hell with it, we're going to Prague. And so we go to Prague and spent 3 days just seeing the city, talking investments, talking a lot about Indivior at the time. And that was right at the beginning of when I launched my fund. And that actually became one of our first big winning investments. But I knew Jeremy prior to that trip, but it was really, I think, and if you look at our WhatsApp group, we're called the Value X Brothers Prague. It's still the name of our group because that trip, I think, was solidified so much. And so that was...
Donnie's earned the right to be
Donnie
a part
to
of
that
that group.
group.
We're going to add him.
Absolutely. Donnie needs to come aboard. But yeah, I mean, dare I say, if I had not gone on that Prague trip, things would have been a lot different. I mean, Jeremy and I would still be friends, but I don't think we would have become as good of friends as we did. And so it's one of those little random moments in life, and it was a great trip.
Well, I love that story because I think it highlights, one kind of Pareto distribution in life is just showing up, right? And I mean, you never know, man, just showing up to things. And, I've learned that over the years, and every time I showed up, I've usually gotten a benefit. Even the very first time of going to Value in Charlottesville, I was like, I don't know if I go, it's kind of far. And it's obviously been this great experience and led me here to meet you guys and have these great conversations. So I love that story, man. It's a great inspirational one, and it's a great one to end on.
Well, it's a good way to end. And we're right, like a little over an hour. 20-minute podcast, huh? We'll see how that goes. But this was such a great conversation. I'm glad that we did it. Jeremy, look, thank you so much for coming on and being our first guest. I think everything that we talked about today, I think, is very thought-provoking in terms of kind of those philosophical questions you need to ask. We need to ask ourselves as investors on how we want to run our business, how we want to run a portfolio, and what really will drive the long-term outsized returns. And so I've enjoyed the conversation. I hope everybody watched, and I hope you guys have enjoyed it as well. And so please join us next time as we will bring on more fascinating investors like Jeremy. Thanks, y'all, for tuning in to Value CVille. And thank you, Jeremy, for being a part.
Thank you, Jeremy.
Yes. See you in Charlottesville.
All right. Take care.
See you guys.